If your P&L swings just because a client paid late, you're not doing bad accounting. You're just missing accrual accounting. Let me show you the clean way. I'm a CPA and I review these entries every month across a bunch of real closes. What you learn: when to book revenue, expense, the 4 common accrual buckets, the exact entries reviewers expect, what to save as proof. Main step by step. Start with cutoff. What was earned, incurred by month end? Service. You finished March work, invoiced $5K, paid in April, debit AR 5K, credit revenue 5K. Utilities. March power bill $900, arrives in April. Debit utilities 900, credit accrued liabilities 900. Prepaids. Insurance paid now, used later. Debit prepaid, then monthly debit expense, credit prepaid. Deferred revenue, cash now, deliver later. Debit cash, credit deferred rev, then recognize monthly. Reviewer notes: red flags, negative AR, giant misc accrual, no reversals, revenue spikes, expenses missing. What reviewers check? AR tied to aging, AP tied to bills, accruals reverse next month, prepaids amortize, deferred revenue rolls forward. Supporting docs: invoice, contract, vendor statement, accrual calc, amort schedule, deferred rev schedule. Quick checklist recap: lock month end date, run AR aging, run AP aging, book revenue cutoff, book expense cutoff, update prepaid schedule, update deferred rev schedule, reverse last month's accruals, attach support in the file. Like na subscribe if you want more reviewer style walkthroughs. Drop a comment with the accrual account you hate most: AR, AP, prepaids or deferred revenue. If this sounds like your close process, you're not alone.